What is going on, everyone, and welcome back to the channel, Explain the Charts. Today, on October 31st, 2025, we are taking an in-depth look at Microsoft, ticker symbol Microsoft. The company just released a blockbuster earnings report that beat expectations, yet the stock took a significant tumble yesterday. This is a classic good news, bad reaction scenario, and we're going to dive into the news and the charts to understand why this happened and what could be next. So, let's get right into it, starting with what's been happening in the news. First, the earnings themselves were phenomenal. Microsoft reported earnings of $4.13 per share, smashing analyst expectations of $3.67. Revenue also came in strong at $77.7 billion, well ahead of the $75.3 billion forecast. The key driver, as many expected, was the incredible growth in their cloud segment, with Azure revenue surging an astounding 40% year-over-year. Fundamentally, this paints a picture of a company firing on all cylinders, largely thanks to the massive demand for its AI services. So why the drop? The market's anxiety stems from the company's spending plans. Microsoft announced a huge surge in capital expenditures to over $34 billion for the quarter, with plans for that spending to increase throughout the year. CFO Amy Hood even admitted that Azure's capacity constraints actually held back revenue, meaning demand is literally outstripping their ability to supply it. While this is a sign of incredible demand, the market is pricing in short-term concerns about margin compression due to this massive spending spree. Despite the sell-off, it's important to note that Wall Street analysts remain overwhelmingly bullish, with many raising their price targets and citing the AI growth story as a long-term tailwind. Now let's see how this narrative plays out on the long-term daily chart. As you can see, Microsoft has been in a powerful uptrend for the better part of a year. The stock made a dramatic move in early April, bottoming out around $345 before beginning this massive rally. It set an all-time high back in late July at $555.45, which is our key long-term resistance level. After hitting that peak, the stock pulled back and spent August and September consolidating, building a strong base of support right around the psychological $500 level. That $500 zone is now a critical area to watch on any further downside. From that base, the stock rallied impressively through October, making a run back towards the all-time highs as excitement built for earnings. It peaked just 2 days ago around $553, showing that the market was extremely optimistic heading into the report. This context is crucial for understanding the severity of yesterday's drop. Let's zoom in on the price action since September 1st to get a clearer picture of this recent move. You can see the healthy uptrend channel that formed throughout September and October, with the price making consistent higher highs and higher lows. The momentum was clearly bullish. Then we see the last 3 candles. The price stalled on the 28th and 29th, right below the highs, showing some hesitation before the earnings announcement. And then yesterday, on October 30th, we got this massive bearish engulfing candle on extremely high volume. The stock gapped down at the open and sold off sharply, which directly correlates with the market digesting the news about increased spending. This candle signals a significant short-term shift in sentiment from bullish to bearish. The low of that candle, at $522.12, has now established itself as the most immediate and critical support level to watch. Switching over to the 1-hour chart, we can see the post-earnings action in more detail. Notice the huge gap down between the close on the 29th and the open on the 30th. The price tried to rally in the first hour but was immediately rejected, confirming the bearish sentiment. The selling pressure was intense through the morning, pushing the price all the way down to that $522 level. However, in the afternoon, we can see the selling pressure began to ease. The price started to form a base in the low $520s, with subsequent hourly candles making slightly higher lows. This suggests that some buyers started to step in, viewing the sharp drop as an opportunity. The stock closed around $525, well off its intraday lows. This small bounce is constructive, but the stock is still in a precarious position below the pre-earnings support levels. Now, let's drill down even further to the 15-minute chart from yesterday, October 30th. Here we can really see the intraday battle that took place. After the initial sell-off, the price hammered down to the $522.12 low around noon Universal Time Coordinated. Look at the volume on those candles. It was significant, but the price refused to go any lower. This was the first sign of buyers establishing a line in the sand. Throughout the rest of the session, the price chopped around in a range between roughly $522 and $528. Every attempt to push lower was bought back up, while every rally was sold into, showing a state of temporary equilibrium. The key takeaway here is that a short-term bottom may have been formed at $522. The fight to hold this level will be the main story in the coming trading sessions. So, what does this all mean moving forward? Let's discuss the bullish and bearish cases. The long-term bullish case is undeniable. The fundamental story of explosive AI-driven demand is intact. Microsoft is spending billions precisely because they can't keep up with growth, which is ultimately a fantastic problem to have. Long-term investors will likely see this pullback as a gift and a prime opportunity to accumulate shares at a discount. For the bulls, the first signal of a recovery would be a firm hold above the $522 support level. From there, they'll want to see the price reclaim the $530 level and then challenge the gap fill area around $540. If it can overcome $540, the path back to the $555 highs is clear. On the other hand, the short-term bearish case is also compelling. The stock just broke its uptrend on massive volume, creating a lot of overhead resistance. Sellers are currently in control. If the $522 support level breaks, there isn't much support until we get down to the October lows around the $510 to $514 area. A break below that would open the door to a test of the major psychological and technical support zone at $500. A daily close below $522 would be a strong confirmation for the bears. To recap, let's lay out the most important levels and our unbiased prediction. Key resistance is now at $530, followed by the gap around $540, and then the all-time high of $555. Key support is immediately at $522, followed by the $510 to $514 zone, and the major floor at $500. Given the strong fundamentals clashing with short-term spending fears, we believe there is a 65% probability that the stock will consolidate in a range between $510 and $540 for the next few weeks. The market needs time to digest this new information. There is about a 25% chance that the buyers step in with force, viewing this as a clear overreaction, and push the price back above $540 quickly. This would be reinforced if the broader tech market remains strong. Conversely, there's a 10% chance of a more severe breakdown where the $500 level is tested, which would likely require a broader market downturn to occur. The key thing to watch for is whether the $522 low holds on the next test. That's our analysis of Microsoft for today. Remember, all content on this channel is for informational and educational purposes only. This is not financial advice, and you should always conduct your own research and due diligence before making any investment decisions. Trading involves risk, and you should never risk more than you are prepared to lose. Thank you for watching Explain the Charts, and we'll see you in the next video.